Hi, hope you're doing good. This is our first video on Indian asset class valuation as per our internal matrix. In this video, we try to explain the valuations of various asset classes like equity, debt, and currency, and also gold. For gold, we use USD gold data. In summary, as per the matrix, the large cap valuation trades at just below 23 years average, but continues to remain high. Mid caps and small caps are definitely attractive. On the debt side, the 10-year government securities continues to trend lower, and we believe it can breach the lowest that it saw this year. In the currency space, especially USD INR, USD did appreciate to all-time high, and we believe the trend can continue further. First on large cap valuation. In the last 23 years, the general average has been about 19 as per our matrix, and the current valuation is just a tad below 19. Historically, investing at these levels has generated a return of about 8 to 13% in the next 5 or 7-year period. So it is not fairly valued. It's slightly on the higher side, but it's not very high either. We have about 5 years data for mid caps, and as per that, the valuations are cheap. And if one were to invest at these levels, with the very small set of data that we have, we believe the 1-year return can be anywhere over 20%. Now that looks difficult at this point in time, but that's what the valuation matrix suggests at this point in time. Finally, on the small caps, the valuations are extremely cheap, but then we don't have too long a data. Plus, we don't have a data on how the markets have reacted at these valuations. Hence, we would avoid suggesting any return at these valuations. For the debt, we track 10-year government security yield. As you can see, it has been trending lower. We turned negative on the yield from November 2018, and we believe it can go down further thanks to a lot of action from RBI. But this view can change or negated if it closes above 6.45% at any given point in time. On the currency side, as you can see, the USD INR has been streaming up very well. We believe US can get into recession anytime, which will create debt deflation of sorts, thereby reducing the velocity of the currency. And hence, many emerging markets like India will scramble to get hold of USD in their portfolios, and thus pushing the USD INR rates significantly higher from here. The USD gold chart clearly shows that the long-term averages are trending up higher, and it can shoot up further if the global volatility increases. The immediate target, if it shoots up, is $1,930 that it saw in the year 2011. So now the question is, what is the right asset allocation if I were to invest today? About 20 to 30% in mid caps is warranted, but for mid caps to generate return, the larger market caps have also should also be stable or should generate positive returns. That looks difficult at this point in time. We are positive on the yields going down further, and hence we are aggressively allocating about 60% in long-term debt funds, which will reduce the volatility and also improve portfolio returns. USD can appreciate significantly from here, and if one wishes to play the INR depreciation story, they can invest up to 5 to 10% in any international feeder fund. But the caveat there is many international feeder funds invest in global equity, and hence, if there's a fall, the INR depreciation play might not really work. And finally, on the gold, it's one of the best plays for INR depreciation. And if the global volatility increases, you can add significant returns to your overall portfolio. and hence we suggest to invest a maximum of 20% in gold ETFs or gold funds. These are our contact details, and please feel free to write to us in case you need any further clarifications. Thank you and have a good day.